Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I want to talk about 5 different companies that are either undervalued or fairly valued at the moment. It's quite difficult right now to find companies that are either undervalued or even fairly valued right now. Everything seems to be going up by every single week. So I want to share with you these 5 companies. But before we do that, just 2 things. The first one is if you can join us in the Discord, that would be absolutely amazing. And that will help the channel. Of course, you can actually get access to all the buys and sells that I'm making, all the frequently updated videos on the in terms of the portfolio side of things, the trackers that I've put together, as well as the Discord, access to the Discord, the access to the Sharia compliant investing ebook, and so on. And as always, just like the video, subscribe to the channel, and let me know if you have any questions. Now, some of you have been asking me about this company for a while, so I want to talk about this company quickly before we move on to the 5 companies that we're going to talk about today. The Archer-Daniels-Midland company has had a horrible, so a year to the beginning of the year is actually down 28%. And the reason it's down is nothing to do with just the basically people wanting to sell it or anything like that. It's a lot to do with this, okay? So they found some sort of accounting situation going on with this company because with the CFO. So they had to suspend, basically they have to tell the CFO he's no longer coming to the company, so they have to give him a leave of absence while he's under investigation. And for that reason, the stock went down this much. Now, we still don't know how deep this is, but this impacts apparently one segment of their business, and that's nutrition segment of their business. And that is basically they're expecting the earnings to basically come down. Okay, the operating income is forecasted to fall more than 18%, okay, for that segment. So we still don't know what is going to happen, because they will be I think by the end of February, I think they said they will be reporting and letting us know. There we go. So it's likely to investigation and accounting practice in nutrition segment before the end of next month, which is basically February. So by the end of February, when they report their 10K, we will know exactly what is going on with the business. So until then, I would say I will definitely not be touching this company. If you own it, you really have to make a decision. Be careful, because what if the situation is way worse than we actually initially thought? It could be better. I don't know what's going to happen. Okay, so in my opinion, in my humble opinion, and again, just please don't just use this as a financial advice. If you own the stock, if you want to own it, just make your own decisions, do your own research. But based on this, okay, I don't know how deep this situation is. I don't know what is going to happen to the company in the long run. People are downgrading, whatever. So they must know something that I don't know. And I don't want to take that risk again. And I say again because I have 3M here sitting down, basically 32% down, basically in the last whatever months, because of situation with the legal, basically situation that's going on with the business. So they've been sued by all sorts of people, okay, including the veterans and so on, because of some earplugs that they've sold a million years ago. Now that's still ongoing, and I still have J&J also kind of going through similar sort of a thing. So I don't want anything else, basically. I don't want to add to the problem. So if I were in your shoes, I would just leave it alone, unless you really do your research and you know this is going to be a beneficial for you, and you know the company, and you have some sort of inside information, whatever it is, that if you've done your research and you feel comfortable, by any means, please go for it. But in my opinion, I would actually stay away from the company. But interestingly, in terms of dividend side of it, because this is one of the dividend kings out there, and it pays almost 4% dividend, they have been downgraded. So from this Simply Safe dividend has now downgraded from 94 to 80% safe. But guess what they've done? On January the 24th, is like 4 days ago, they've increased that dividend by 11%. So that's attractive, but at the same time, I really don't know what is going to happen moving forward. For that reason, I'm just going to leave the company alone for now. And of course, you do your own research and so on. Right, let's talk about the 5 companies that we came here to talk about today. So the first company we are talking about today is AstraZeneca. AstraZeneca is one of the companies that I own in my portfolio. Is UK based pharmaceutical company. It has 208 billion market cap. It has a wide economic moat. Current price is $67. Dividend yield of 2.26. Payout ratio only 40%. And the latest increase, according to SimpliSafe Dividend, the UK companies sometimes a bit funny to find their dividends. I use Dividend Max, but for this reason I just use the SimpliSafe Dividend because it has all that information in one place. So I just use that. Dividend streak is just 2 years. Annual payout $1.8042. Safety 70% and profit margin of 13%. Return on equity 16%. Return on invested capital of 20% and free cash flow of $6.9 billion. Total return in the last 10 years, we're looking at about 10%, which is quite nice. Growth estimate for next year is about 16%, and growth estimate after that is also 13%. 11% discounted right now. $78 per share is where they think the price should be. Right, if we go back here, and I'm going to show you in terms of earnings. Okay, so if we go to estimates for the next year, remember this is just estimation, this is not accurate information, this comes from analysts, it could change easily. But in 2023, when they report their final quarter, I think that's about 10% growth. After that, in 2024, about 15%. And again, there's only 2 analysts looking at 4 analysts, but about 22% moving forward. Again, when it comes to the revenue side of things, moving from $45.7 billion to $57 billion in space of 3-4 years. So about 3%, 10%, 8%, and then 5%, which is quite decent for this company. And in terms of ratings, you can see as Wall Street is actually saying a strong buy. Seeking Alpha Analyst is saying it's a buy. Quants is actually saying a hold. If we go to Wall Street, see why they're saying a strong buy. They are expecting the earnings to basically the price to be about $80 per share by the end of the year. So that's 20% upside from where we are now. Right, the next company we're looking at, Tractor Supply. This company has a market cap of $24.6 billion. It has a wide economic moat. $227 per share is where the price is at right now. Dividend yield of 1.8, payout ratio almost 40%. Latest increase was 12%. The 5-year growth rate about 29%, and dividend streak of 12 years. So increasing that dividend. Current dividend is $4.12. Safety 68%, which is quite nice. 61 and above is safe. Profit margin is 7.58. Return on equity 55%. Return on invested capital about 21%, which is quite nice. Free cash flow less than $1 billion right now, about 900 million. Total return in the last 10 years, we're looking at about 13%. Growth estimate next year is about 3%. Growth estimate after that for the following 5 years is 5%. Fairly valued at the moment. $212 per share is where they think the price should be. Now, if we look at Seeking Alpha, as you can see, Wall Street is actually saying is a buy. Seeking Alpha is saying is a buy. Wall Street has a price target of $222 per share. That's almost like more than $5 basically, less than $5 where it should be. If we look at earnings, or where it is now, and about 3%, 6%, 7%, or 8% in terms of their where is the revenue? Wait, yeah, definitely something is going on because it's reporting FFO, which is normally for REITs. But yeah, revenue is absolutely fine. There's no issues with that. So that's the second company. Third company we're looking at today is Cisco. I'm sure you all know Cisco product. 212 billion market cap, wide economic moat, $52 per share right now. Dividend yield offer just 3%. Payout ratio 38%. Latest increase was 3%. 5-year growth rate of 4%. Dividend streak of 12 years. Annual payout $1.56. Safety 91%. Profit margin 23%. Return on equity 31%. Return on invested capital also 31%. Free cash flow $17 billion. Total return in the last 10 years, we're looking at about 10%. 4% growth after that. Growth estimate for next year is 4%, then 6% after that. Fairly valued at the moment. 53%, $53 per share is where the price should be. And looking at the earnings expectations for Cisco, if we go down here, you can see 2024 is kind of nothing there. 2025 about 4%, and then about 5% after that. Again, similar sort of a thing. This is one of those I like to call steady Eddie kind of company where there's not much of a growth in terms of the top line, bottom lines, but you get your 5%, basically 4% every single year. It kind of balances the portfolio as well. But as you can see here, it's about 3% from upside from where we are now. Next one is one that I own in my portfolio. That's United Parcel Service. that has a market cap of $136 billion, wide economic moat, $159 per share. Dividend yields 4% right now. The payout ratio is 64. Latest increase was 7%, and the 5-year growth rate about 13%. Dividend streak of 13 years. Annual payout $6.48. Safety 69%. Profit margin 9%, and return on equity of 47%, which is quite nice. Return on invested capital or like 20%, which is really good. Free cash flow over $5.5 billion right now. Total return in the last 10 years, we're looking at about 8%. Growth estimate for the next year 9%. Growth estimate for the next 5 years, they're expecting a decline of 7%. Fairly valued right now. $164 per share is where the price should be according to Morningstar. Now, if we go to Seeking Alpha, go to Wall Street expectation. Let's go to the earnings first. And if you look at the earnings decline in 2023, that's the reason why the stock was down so much. Next year, about 9%, 12%, 11%, 16%. I like that. And there's a lot of analysts looking at this company. So I like this. Okay, this makes me happy. The fact, and I own the company, like I said, in my portfolio, almost 5%, 4%. Again, it's that 5% to 10% every single year, basically, that they return to growth side of things. And ratings, and right, looking at it now, you can see is a Seeking Alpha is a buy, saying is a buy. Wall Street is a buy. And Quant System, which is what they use, is saying is hold right now. If we look at the Wall Street expectations, the price is basically 168, about 5%, 6% upside from where we are right now. Final company we're going to talk about today, Abbott Laboratories, 194 billion market cap, is one of the pharma companies out there. Narrow economic moat, price right now $112 per share, almost 2% dividend yield, 46% payout ratio. Latest increase was 8%. The 5-year growth rate was 12%, and dividend streak of 51 years in a row. That means they are dividend king. Annual payout is $2.20. Safety 90%, profit margin 14%, return on equity 14%, return on invested capital 13%. So that's solid. Free cash flow $4.5 billion. Total return in the last 10 years 13%. Growth estimate basically 11% next year, and then 8% after that every single year. Fairly valued at the moment. And looking at Seeking Alpha, if we start with earnings first and go to estimates, let's have a look. 4%. 11%, 5%, which is decent. Again, 4, 5%, 7%, 7%, and then so on. Not bad at all. That's what you can expect from these old companies that have been around for generations. And as you can see here, it's about 10% upside from where we are right now. So there you have it. That's the 5 companies that I wanted to share with you guys today. Again, as always, do your own research, find out a bit more information. Some of these companies might be the companies that you want to invest in. Some of them you might not be in line with your investment strategies. Whatever it is, you do what you need to do. And from Sharia compliance side of things, you can have a quick look, pause the video. As you can see, there's absolutely no issues in any of these companies. Majority of them, apart from the attract and supply, is about the interest bearing, that's about 22%. The rest of them are fairly okay, and the business side of it is absolutely fine. Right, that's the companies that I wanted to share with you guys. Don't forget to join us on the Patreon account, and don't forget to like the video, subscribe to the channel. Let me know if you have any questions. Inshallah, I will be doing a portfolio update in the next couple of days, so stay tuned for that as well. Assalamu Alaikum.